Hello, this is Michael Ross from Westchester Capital Planning Inc.com, and welcome back to our series on finance and investing. Today we will be discussing the efficient market hypothesis and how it impacts the stock market. So let's dive in. The efficient market hypothesis is a theory that suggests all valuable information is already reflected in the current market prices of stocks. This means that the stock market is always trading at fair value, and it is impossible to outperform the market consistently by picking individual stocks. The hypothesis was developed in the 1960s by economist Eugene Fama, who argued that in an efficient market, any new information about a stock would be immediately factored into its price. This means that there are no opportunities for investors to buy undervalued stocks and sell overvalued ones, as the market will quickly adjust to this new information. There are three forms of efficient market hypotheses: weak, semi-strong, and strong. Let's take a look at each of these forms in more detail. The weak form suggests that all past market information, such as price and volume data, is already reflected in the stock prices. This means that technical analysis, which is based on historical stock price movements, cannot be used to predict future stock prices. Therefore, it is impossible to gain an advantage by studying past trends. The semi-strong form states that not only past market information, but also all publicly available information such as earnings reports and news articles are already factored into stock prices. This means that even fundamental analysis, which looks at a company's financial health, cannot help investors gain an edge in the market. Lastly, the strong form of the efficient market hypothesis claims that all information, public or private, is reflected in the stock prices. This means that insider trading, where individuals have access to non-public information about a company, is also unable to provide any advantage in the market. Now, you might be wondering, if the efficient market hypothesis is true, then how do stock prices ever change? Well, the hypothesis also takes into account the concept of market efficiency, which means that stock prices are not always perfectly accurate. The market may be efficient most of the time, but there can be times where certain stocks are overvalued or undervalued due to market sentiment or human error. So if the stock market is always at fair value, then why do we see investors making large profits from stock trading? This could be due to luck, risk-taking, or short-term market inefficiencies. However, in the long run, consistently beating the market is nearly impossible. One important implication of the efficient market hypothesis is that it challenges the idea of actively managing a portfolio. This means that instead of trying to outperform the market by picking individual stocks, investors should focus on building a well-diversified portfolio that covers different industries and asset classes. In conclusion, the efficient market hypothesis suggests that it is impossible to consistently beat the market by picking individual stocks. While it may seem like a limiting theory, it does highlight the importance of diversification and taking a long-term approach to investing. As always, it is essential to do your own research and consult with a financial professional before making any investment decisions. As always, click the like button if you have learned anything of value in my presentation. Thank you very much, and have a nice day.